So far, more than half of the S&P 500 companies have reported earnings. And according to Reuters, more than 73% have beat on earnings. 55% have beat on revenue, that's sales. Joining us now is Aaron Kennon, CEO of Clear Harbor Asset Management. Aaron, good to have you on the show.
Great to be here, Michelle.
We're more than halfway past the start line for earnings seasons. Aaron, what's your take so far? Are we seeing enough growth in terms of sales and revenue?
Well, certainly we are seeing growth in particular segments of the economy. Technology's had a great start. Q4 technology growth is about 15%. Energy, on the other hand, has been under significant pressure due to the lower commodity price environment. Energy companies have seen their earnings decline by over 20% over the course of the fourth quarter. We would expect that to most likely continue, particularly into the first and second quarter of this coming year.
So it's really been a very sector-specific earnings season so far. Some sectors doing exceptionally well, like technology, others, like energy, not doing well. And another sector that really disappointed was financials. We had really bad earnings from the likes of JP Morgan, Bank of America. What's going on with the financial sector?
Financial sector is a tale of two cities in some sense, because you have certain financials that are seeing their net interest margins shrink somewhat significantly. Let's not forget, too, that financials also include insurance, and property and casualty has seen their pricing sort of flatline now for the last several quarters. They're under a lot of pressure, a lot of competition. We're seeing actually M&A activity there right now. So there's also some exposure, of course, in the emerging markets with a lot of the U.S. banks, and with the strength of the dollar, that's weighed on earnings a bit.
Before we get more onto the strength of the dollar, I want to talk about the picture that earnings is giving us about the economy overall, because this is showing us how the biggest 500 companies in the economy are doing. We had a fourth quarter GDP of 2.6%, missing the forecasts of 3%. Is the picture that earnings painting compatible with the data that we're getting from GDP? Is it sending the same message?
I think so, in some regard. I mean, let's not forget that earnings ultimately drive the equity markets, but GDP, unfortunately, is not highly correlated to the directionality of equity prices. We're probably going to see slower but positive earnings growth in 2015, which is sort of indicative of what we've seen now in the fourth quarter of 2014, just for the last couple of weeks, of course. And I think that's really the takeaway, that we will see positive earnings growth in 15, but we're not going to see the 10% earnings growth that we saw in 2014 or 2013. There are some headwinds out there.
Well, what are those headwinds, and what is the picture that these earnings so far painting about the U.S. economy?
Well, I mean, I think that, for example, there's a question about margins. We've seen a nice expansion across many sectors over the last several years as it pertains to margins. The unemployment rate continues to fall, and we think margins could come under pressure if the unemployment rate continues to fall, particularly
because we have to raise
because we need to raise wages. Exactly.
Okay.
Yeah, and so that's one headwind. The industrial sector is witnessing a headwind right now from the strength of the U.S. dollar. So if you're a German industrial company with a lower euro, you're much more competitive to the identical company in the United States producing the same product in the United States.
Well, let's talk about the dollar. On the one hand, it'll be good for domestic companies that have most of their sales from the U.S., is that correct? But not so good for multinationals with a lot of global exposure.
Well, that's right. And the S&P, when you look at earnings and how it pertains to international exposure, about 31% of revenues, not exactly earnings, come from outside the United States. A great deal of that is consumer goods, Procter & Gamble type company, industrials, Caterpillar, selling their goods throughout the world. So certainly they're under more pressure, and they're not hedging their currency exposure. There are very few companies that are doing that. Honeywell, for example, is one industrial company that is hedging some of their dollar exposure in this current environment.
Well, Aaron, you're speaking about overseas growth. Yum Brands just reported after the bell. They had a 16% drop in revenue in China. It was actually better than expected. They were expecting a 19% drop, or analysts at least. But the big picture here, with China's growth declining, what impact is that going to have on companies like Yum and other companies with a big presence in China?
Well, it's huge, and it's having an impact. China deceleration is having a huge impact on the demand side for base metals, copper. You look at the price of copper, certainly the last 5 days we've seen copper rebound. The mining sector, Australia's economy, which is very dependent on Chinese demand for these goods, and of course Australia is a huge mining exporter. On the food side, certainly you'll have a deceleration in consumption. But China is clearly making an effort. We just saw that even overnight with them reducing their reserve requirements another 50 basis points to try to stimulate further lending and more growth going forward.
Okay. Well, we're going to have to leave it there. Thank you so much, Aaron Kennon, CEO of Clear Harbor Asset Management.